That is the closing bell on Wall Street, and now it's market domination overtime, giving you full coverage, all the moves to get you up to speed on the action from today's trade. Yahoo Finance's very own Jared Blikre joining us now to break it all down. Jared, what do you see at that close?
Well, thank you, Josh. The Dow is not up by a lot, just over 40 points or 0.1%, but that is enough for a record closing high. And I'll show you the intraday price action. Here you go. Off of those highs there, we had kind of a double peak from earlier in the day. That was beginning of that formation. Here's the NASDAQ, another record high, up almost 0.5%. S&P 500, similar boat, record there, up 1/3%. If we look at the small caps, here's the S&P 600. That is good for 0.25%. Not a record there, though. And let's move on to the sector action, where we saw healthcare really surging today. XLV is that sector for the large caps. That is the ETF, up 3%, by far and away the biggest gainer of the day. Second to that is utilities and then tech. Both of those up just under 1%. Both of those have record highs as well. And add to the mix here of outperformers, consumer discretionary up 0.6%. But what did not work today, communication services down 1.4% and materials down 1% respectively. So let's go to the NASDAQ 100, where we see Tesla as an outperformer. In fact, a lot of the chips names are pretty much in the dark green today. Let's just switch over to that real quickly. Just noting the brief loss that we saw in Meta, down 2%. But here are some of the outperformers. Intel up 7%, Lam Research up 6%, so is Applied Materials, so is ARM, and also TSM and ASML each up more than 3%. But as we've been seeing recently, software not as bullish. We do have some outperformance by Datadog, that's up over 7%, but we do have some losses. Atlassian down 6%, DocuSign down 6%, and Workday down about 3.5%. Let us go over to the Dow now, and here's where I'll close. That's where we see a little bit more red. Aside from some of those healthcare names, and Merck is up 7%, Amgen up almost 6%, we are seeing some losses in JP Morgan, Walmart, Home Depot, each of those down by more than 1%, along with McDonald's, Disney, Goldman Sachs, and American Express. Back to you, Josh.
All right, thank you, Jared. Well, it was, as Jared said, a record-setting day on Wall Street. The S&P 500 closing at a new high, as investors seem to believe the government shutdown will be short-lived. Joining me now, we got Stephen Dover, Franklin Templeton Chief Market Strategist and Head of Franklin Templeton Investment Institute. Stephen, it is good to see you. So maybe start big picture, Stephen. You know, Q3 was solid. I'm curious what you see ahead for Q4, factoring in this government shutdown.
Yeah, so I think our basic theme, we call it broadening. We think the market's going to broaden and stay higher. Flattening, yield curve is going to flatten, and weakening. The U.S. dollar is likely to weaken. I think your interview you just had and the comments you made say a whole lot, that we're now seeing some M&A activity and we're seeing more IPOs. So we did a study, we looked over the last 50 years, and there have been 8 instances when the Fed cut rates in a growing economy. And whenever that's happened, 100% of the time, the market has been up a year later. Not to say there hasn't been volatility during that year, but the S&P 500 averaged up 17%, NASDAQ 25%, the Russell 2000 20%, and really interesting, emerging markets were up 27%. So you've known me over a period of time. I tend to be more of a value investor, so it's unusual for me to talk this way about the market, particularly at a scary time when the market's at an all-time high. But we're generally positive on the fixed income space, looking shorter duration now, but we're going to lengthen that probably as we roll into the year, and looking at a broadening of a market. So opportunities, maybe some small cap opportunities, but also opportunities overseas.
Let me ask you, Stephen, about this government shutdown. Listen, you look at the reaction right now. Markets seem to be shrugging this right off. Is there any risk in that response, Stephen? Is there a risk of complacency here? What if this goes on longer than we imagine? The two sides right now don't seem to be blinking. I mean, what could that mean for the economy? What could that mean for the markets?
Good question, and a little bit unknowable, bluntly. Since 1976, we've had 21 occurrences where the government has lapsed. Seems like, that's more than an annual event. The longest was under the Trump administration, as you know, 35 days. All that's been reported. But in almost every case, the market's actually up after a government shutdown. this might be a little different because it seems very political and might have some impact on government employment. We have a funny thing going on with the numbers. GDP seems to be pretty strong. The labor seems to be a little bit weak. How do you explain that with consumption still up? I think probably the answer to that is productivity. But the blunt answer to your question is if we have big government layoffs, where we could see some weaknesses in the labor market.
I'm curious, Stephen, what you made when you heard Jay Powell kind of weigh in, and you heard our own Fed chief suggest we're looking kind of stretched here in the markets. What did you make of that?
Well, I think that it is a argument when we're looking at risks. Obviously, we're always concerned about a recession. We've been worried about the recession risk for the last 3 years, a very talked about recession that's never happened. But there's also upside risks. And I do think that we're in a stimulated economy right now. All sorts of things are happening from the Fed loosening, strong earnings, strong capital spending, fiscal and regulatory and tax support, AI productivity boost, lots of cash on the sidelines. There's a lot of stimulus going on right now. And I think we're worried about a melt up. I think that's a possibility. Very positive thing in the short term, but historically has long term turned out to be painful.
So in the stock market right now, Stephen, where do you want to be positioned? What sectors do you want to be overweight?
So I think that when you're looking at a situation which is so broad, you want to be broader. So you want to look at those areas that really just haven't caught up. You want to look at the small caps. You want to look at you want to look at overseas, Europe. We're actually pretty positive on the emerging markets right now. So we're not negative per se on the large cap stocks, but we're just saying that it's likely to broaden, the market's likely to increase, but that doesn't mean there isn't some risk there. And to participate in that, you want to be broad. I think the other issue is there's just a lot of cash on the sideline lot now. A lot of people actually sold in April. And, this is the value trap. They don't know when to get back in. And now the market's at an all-time high. And it's scary to get into the market. So what we're saying is that we're pretty comfortable that the market's going to be flat to up, that any pullbacks in the market are probably opportunities to dollar cost average in. We're not saying go all in, but if you're sitting on a lot of cash right now where interest rates are going down and there's a lot of stimulus in the market, you probably want to be more in the market.
Final question, Stephen, for fixed income investors who are listening right now, your advice, what's your guidance?
Get out of cash. Get into at least short-term fixed income. Those 5% rates were great, but they're by definition not happening anymore. So you at least want to get into some duration, 3-5 years we're talking about. But we need to look, if we're right about the yield curve, probably as we roll into 2026, we're going to be making some recommendations to increase duration a little bit further.
Stephen, great to see you. Thank you, sir.
Thank you for having me.
Coming up, we're taking a look at sales trends from automakers, more market domination overtime right on the other side. Consumers rush to get their hands on electric vehicles before the expiration of the EV tax credit. Automakers Ford and GM getting a boost, seeing records for EV sales in the third quarter. But now that tax credit is in the rear view mirror, and we're looking at the road ahead for the auto industry and dealers. Cox Automotive Executive Analyst Aaron Keating joining us now to discuss. Aaron, it's good to see you. So not surprising, right, Aaron? We expected and we got strong EV sales from Ford and GM. But let's look ahead now, Aaron. You look at that EV market, you take out your crystal ball, Aaron, post-subsidies. What do you think that EV market looks like here in the U.S.?
Well, thanks for having me, Josh. I always enjoy talking with you about the car industry. And to be honest with you, we don't see that things are going to fall off a cliff. Look, we're going to see a speed bump here with demand. But we already heard today, even in some of the sales release calls from the manufacturers and from articles that came out yesterday, that GM, Ford, Hyundai, they're all still holding on to some really decent incentives to continue to juice the market for the EVs. So until inventory really draws down towards the end of the year, I think that we're still going to see some really good deals on EVs. Just because the EV credit went away, yes, that might hurt it, but we're now going to get to see the EV in the wild, if you will, see what the market really shows. And we've got a lot of EVs hitting the streets over those last couple of months, which means that attention is more on them, and we might start seeing more and more people getting used to seeing EVs and wanting to buy more. So I'm a little more bullish than maybe others are on how EVs are going to do in the future.
Well, let me get your take on this, Aaron, because I saw reports, Ford's Jim Farley was talking about this yesterday, and it sounds like Farley expecting demand for EVs to be cut in half next month following the end of these tax incentives. And I'm just curious what you made of that statement.
It's funny. I was listening to then Randy Parker this morning on his monthly sales call, and he said quite the opposite. And so I think it depends on which manufacturer you are, what is your plan for electric vehicles, and how strongly do you sit in that portfolio line? We know that Hyundai, as an example, has really invested. They're very EV forward, very electrified forward, and they're going to be invested in continuing to make sure that that powertrain gets adopted at a larger scale in the U.S. And I think there's quite a few other manufacturers that are going to do the same. Now, we've already heard of some cancellations are slowing in production, and that will sort of help us see what demand looks like versus sales and supply. But I don't think that the 5%, cutting it in half over the next month is terribly realistic.
So we're talking Ford, we're talking to GM, Aaron. What about Tesla? Because Tesla deliveries, they're on deck as well. I'm curious what your expectations would be there and ahead.
Yeah, I think Tesla's going to continue to compete, right? They are the one brand that's easiest for them to adjust their pricing up or down based on what they're seeing in the market. And the only shot they have in the market is an electric vehicle, right? So I don't know that they're the most natural competitor to look at, because by the very virtue of what their portfolio of vehicles are, they have to juice the sales, so to speak, on EVs if they want to continue to get their sales numbers in. But they have been quietly losing share based on the fact that there are a lot of other alternatives in the market. And those alternatives are hot sellers right now, even right up until the deadline as of yesterday. And I think we'll continue to see that trend move on.
We're talking to EVs, Aaron. Hybrids have been strong as well. Do you expect them to stay strong?
Absolutely. I think that if nothing else, this entire exercise with boosting EV sales with credits and so forth has only raised the profile of hybrids. There is absolutely no reason why someone looking at a vehicle on market wouldn't consider a hybrid if it's available. They are becoming closer in cost parity to internal combustion engines. Toyota, on their call today, even was talking about the fact that they're now bringing in their new RAV4 only in hybrid. They were very successful when they did this with the Camry. And it just shows that at the mass market level, people are willing to accept hybrids over internal combustion engines so long as price parity is there.
What about the tariff threat, Aaron? We've talked a lot about that together in the past. I'm just curious, how are automakers continuing to sort of navigate that dynamic?
Well, I think, again, it's still this game of no one's wanting to move first. Everyone's sort of looking to see, hey, where within my segment, that my killer segments, is a competitor willing to move forward in that pricing? Should I then go ahead and meet them there because they're able to still make sales at that price? I think in 2026, we're going to start to see more impact because we are going to have more brand new models coming into the variety that are available to consumers. And therefore, that's a natural place to raise prices on vehicles when you have more equipment, newer equipment, new technology, so on and so forth. But it's still a guessing game as to how it's absolutely going to show up to consumers. There's a lot of tailwinds for the corporations right now, and that is holding them back from really being reactionary to the tariff news cycle, if you will. We still don't have USMCA figured out, and that's a huge component for anyone trying to sell in the U.S. market. And so with that still out there is not confirmed and uncertain, we're going to continue to see this trickle along for the next couple of months before we see some real pricing impact.
All right, Aaron, always good to see you and to have you on the show. Thank you.
Sure. Thanks for having me.
Well, it's the first trading day of October, and Yahoo Finance's Jared Blikre is breaking down what investors can expect.
September was supposed to be the worst month of the year, and it's almost in the books, and it wasn't even that bad. Today, we're going to take a look forward to October, and we're going to be breaking down seasonality. So let's do that real quick here. Seasonality is the predictable and recurring changes in data that happen at about the same time every year. And we take a look at it sometimes a presidential cycle, it might be every 4 years, but the bottom line is we're looking for recurring patterns. And so let's start with this bar chart first that shows each month having a return, and this is just the median return since 1990. And the median is kind of like an average, except that it's not so skewed by large outliers or underliers there, to the upside or to the downside. And here's where we are right now. We're still at the end of September. As I mentioned, it was supposed to be the worst month of the year, but actually it was pretty good. And in fact, we were expecting the last 6-7 days to be all negative, and we got a few bouts of negativity in these days, and we still have 2 more closes to go. But nevertheless, we're probably going to close with some decent returns, at least in some of the indices. Now we can look forward to what is the most positive quarter of the year. And I'm going to be breaking this down in part tomorrow too, the fourth quarter. But today I just want to cover what's happening with October. And here's another look at the full year. In white is what has actually happened. And you're going to note here that this was a big post-Liberation Day sell-off and that quick recovery, which is one of the quickest returns to highs that we've ever seen in the market. And then I have 2 different models. One is a median since 1990. That's in green right here. And in blue, we have the median since 1928. And that is where each day of the week has to match what we are in presently. So if, for instance, it is Monday, September 29th, we just have to look at those Monday, September 29th throughout history, except we're mapping this into October. And you can see here real little that we did have this sell-off in the white line that kind of matched what we were expecting in that median since 1928, same day of the week. And that has actually become my preferred model. This has become a pretty good predictor of what's happening. So here we have that same model, median since 1928. And let me just trace out what we are expecting for the month of October. And you can see we rise pretty quickly in the early part of the month, and then we kind of drift lower into the end, but then we got a little bit of a bounce at the end. And we also have that other model, median since 1990. That more or less kind of revolves around the unchanged. It goes slightly negative in the middle of the month, and then delves into the positive towards the end. The point is, depending on how you slice and dice the data, you can come up with wildly different models. And so I'm not trying to confuse people, but there are different ways to do this. And so you might see some different seasonality results from different people who are doing a lot of these studies. But again, my favorite here is median since 1928, same day of the week. And for that, we are expecting some outsized performance in October. Now I want to move on to a different market. This is the VIX, and in white we have the average VIX since 1990, which is when it began, and then in green we have what's happened this year. And the VIX responds to volatility, and it's looking forward to options changes, basically what the options market is saying about changes in the S&P 500. And what sticks out is this huge spike. That was a Liberation Day spike that we got there. And what you're going to notice is even though the model, the average drifts up into October, and that's when we've seen a lot of market crashes throughout history, we've seen muted volatility so far. So the potential is for volatility to rise. We just haven't seen it just yet. So to review here, we have performance leaning positive in October. Volatility tends to rise. Notwithstanding that, I also want to point out that we have more than average trading days. Usually it's 21. We're dealing with 23 here. And also for Indigenous Peoples Day on October 13th, stock markets are open. Bond markets are closed, and your bank is probably closed too. So having said that, tune into the next Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
Time now for what to watch. Tesla is reporting quarterly deliveries. Analysts expect the expiring EV tax credit in the U.S. to provide a boost to deliveries for the electric vehicle maker. It's coming as Ford posted a 7th consecutive month of sales gains and saw a 30% rise in EV sales for the third quarter. General Motors also reporting another EV sales record. Turning to the Fed, Dallas Federal Reserve Bank President Logan to speak in Austin, Texas. Logan to make remarks at the UT Evolving Energy and Policy Landscape Conference. Her commentary is expected to provide insights into the Fed's economic outlook and monetary policy. On the housing front, Freddie Mac is set to release its weekly report on U.S. mortgage rates. This comes as mortgage rates inched up last week following several weeks of declines. The housing market recently seeing U.S. home contract signings surge in August, while the pending home sales index rose by 4% in the month. And lastly, the weekly initial jobless claims report will not be released as the U.S. finds itself in a government shutdown. Economic data from the U.S. Labor Department will be halted. That's going to do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after closing bell. But don't go anywhere. On the other side of the break, it's asking for a trend. I've got you covered for the next half hour with the latest and greatest market moving stories. Stay tuned.